We got the big rotation going on, ladies and gentlemen. All the investors are looking towards risk on, away from their current girlfriend. Risk off. Yep, the current girlfriend of 2022. We got a lot to talk about in today's stock market brief, hopping right into it. Look, there's two things that traders say frequently. One is don't fight the Fed, and the other is don't fight the tape. Now, when I think of the Fed, I think more macro view. Macro views are typically longer term cycle type plays. All right, playing for 3 months or even potentially even longer. Where don't fight the tape could be shorter term. So what happens when these aren't in sync, right? Because we have something that's going on right now where, hey, the market is actually going up, but yet we would be fighting the Fed to follow that tape. Okay, so when they're not in sync, it depends on your time frame. We're going to show you kind of really what that looks like here, breaking it down into the shorter time frames and then zooming it out so you get a good idea of the bigger picture. This allows you to be more proactive with risk management. Now, as far as risk on, risk off, I'm going to show you a visualization here on this specific chart. This right here is safety ratios. These are relative to the S&P 500. What relative to the S&P 500? We're looking at gold, utilities, consumer staples, TLT, DEF is defensive, and XLV. Okay, if you take a look here at this pink line going across the screen like this, okay, what do you notice these lines doing? You notice them going down for the most part, right? So XLU, defensive sector, down. Consumer staples, relatively defensive sector, down. TLT, flat. Defensive names, down. Healthcare, down. The only one up in this basket right now is currently gold. On the flip side of this, if you look at the FANG stocks, or previously FANG man stocks, where we have the likes of Meta relative to the S&P 500, Apple, Nvidia, Google, Microsoft, Amazon, Netflix, and Tesla. Take a look over here. What do you see these doing? Well, you see the lines going up, okay? For the most part, these are going up, except for Microsoft is relatively, it's down on the year as far as relative strength. Amazon is up, Netflix, and then Tesla has been going up there too as well. So what does this tell you? It tells you that these risk-heavy, risk-on type assets in 2023 have been moving up and outperforming the S&P 500, whereas safety trade has not. That is the rotation that I am talking about. However, I want to back you up and just show you this chart. This is the NASDAQ composite. This is a great way to see the overall market, especially when it comes to growth names. What we haven't seen here, the pink box right over here, this is 2023, and it's been a great start to the year. But what we haven't seen is any sort of consolidation or digestion of this current move. So when you zoom out, right, if you're just looking in 2023, creates a lot of FOMO, a lot of fear. You zoom out only a few months, and you notice that we're just coming to the top of a range, and we're still below a declining 200-day moving average. So I hope that gives you insight as to really kind of see what is actually taking place in the market. Now, if we get out of this box, that could be quite bullish. And as it stands right now in 2023, it is quite bullish, right? Despite what has been going on in the economy, how we're seeing, decelerations, it looks like we're heading into a recession. There's a million things that you could find out that are negative, but guess what? The tape is telling you otherwise right now in this particular point in time. We had Microsoft report earnings. It started off great, but then the call came out and it knocked it right back down. I didn't talk about this. I'm not going to talk about it too frequently. These red lines, I just want you to know these are expected moves. If you have no idea what expected moves are, you need to go to my description and click the video where it talks about like the predicting move video. I show you how to find these expected moves. This is implied volatility. Okay, it allows you to see what the options market is pricing in as far as risk to give you a good idea as where price may go. And you could see here, we came to the top, tagged it with darn near precision. And then this morning, we came back down to the low end of this. So a huge, massive move in volatility, which I don't think volatility is going anywhere. You have Tesla that just reported after earnings. We have looking at about a $12, $13 expected move here. Hasn't really moved, but remember, it's going to really be dependent on that earnings call and see how it goes. So it's highly likely to see Tesla hit, up into one of these ranges. If it comes up here, that'd be pretty insane. That'd be a big move outside of its weekly expected move, which its weekly expected move was right at about this range right here. I know I don't have it on the screen, but I was watching it intraday as I traded a short-term trade out of this consolidation to the upside right there. I actually recorded it, but I had to leave my house because I'm selling my house, so I have a lot of people coming through it, which, by the way, that's why I'm recording so early right now. We're going to look at the S&P 500 on the daily time frame. We're still in an overall downtrend, but we're trying to work ourselves out of this area, of this downsloping trend line, okay? And back above that 200-day moving average. Mind you, the 200-day is still declining. We're right near that upper weekly expected move. What I'm shocked at right now is despite seeing positive price action, we haven't even really made a big break to that 4,200 area, which it just seems like it's open air, and I think it's a possibility still. But yet 3,900 is that level of contention where we have so much volume traded, and it's highly likely also to pull just in a snap of the finger back down there. And we'll tell you what can potentially bring us right back down there momentarily. If you take a look at the S&P 500, this is back on the daily time frame. Look at, we're above the year-to-date anchored VWAP. When we're above the year-to-date anchored VWAP, it's safe to say to be bullish, to look for bullish trades. When we start getting below it, think of it as a pendulum, right? The average buyer for this year, the average buyer of the S&P 500 or the SPY is in the green based off of volume. Now, what happens if we get below that line? It means that the average person is now underwater. And now when the average person is underwater, like, what do you think happens to sentiment there? It typically gets more bearish. And the farther we get from it, it could produce more sell-side activity. Now, if we look at the SPY on the 15-minute time frame, the upper weekly expected move is not too far off here. We do have a descending, broadening wedge pattern. So if we do break up, it could come retest this top and potentially shoot a little bit higher. That would bring us to the upper weekly expected move. The PMO is bullish as it stands right now. It's trending bullish, but just pay attention that if we do crack up into this area, we'll probably have a subtle negative divergence there, and most likely a subtle negative divergence there on the RSI. We're above a 5-day moving average. The 5-day moving average, it is inclining, as you can see with this purple line right here. So that is positive. Where do we come today? We came through it. This is known as a U-turn trade. So if it broke down right, very bearish, it broke down through it, and then it U-turned right back up, allowing for a potential to trade there, and you have a low, stop loss at the low of the day. That's one of my trades that I love to use, not just with the 5-day, but I like to use anchored VWAPs when I trade that. If you take a look here, I want to show you a couple more anchored VWAPs. This one here is that year-to-date anchored VWAP, but this one right here is also important to watch. This is the week-to-date anchored VWAP. So price action, the average buyer since the beginning of the week is in the green. Okay, not for a long time. It's been quite choppy, but the average buyer is now, based on volume, in the green. So that is a bullish sign. If we start getting above this, it's very likely that we could come tag this upper weekly expected move. It's going to be very interesting to see once we have these data drops and once, you know, the earnings are reported for Tesla, where we open up overall. Let's walk into the next thing here is tomorrow we do 1 hour before the market opens. We got durable goods and GDP growth rate coming out. These are two things an hour before the market opens up that can shake this market to its core. Those are major reports, and you should just be well aware that they're coming out. You should have been made aware prior to this that these can come, you know, rock markets, both in a positive way and potentially a negative way there too as well. Okay, what else do we got going on coming up tomorrow and for, you know, the rest of this week as far as earnings go? We got a couple big reports coming out. We got, you know, Dow, MasterCard, INTC, Visa, AXP, CLCVX. I'm not going to go through them through them all. I will say Charter. This is like communications. Communications have been doing good, but if you pull up a chart of Charter, it's been completely vertical. So part of me wants to look into shorting that. I don't know if I'm going to yet. Let's zoom out and look at a bigger picture. Where are we in the S&P 500 on a weekly time frame? We're butting our head up against the 50-period weekly moving average. The last couple of times we have done that, it got rejected and got rejected. As you can see, the 200 weekly moving average is inclining, and we did hold that as a level of support. So as it stands right now, getting back above that 50 weekly moving average and back above 41 on a weekly basis, that is positive. Okay, so as it stands right now, it's not looking all too bad. But remember, big reports, earnings season, things can change quick. So you need to be aware of the macro environment, right? Don't fight the Fed, and the tape. Let's move forward. Zoom out even further. Monthly chart right here. So every candle represents 1 month. These lines on the screen, these thin black lines right here, represent the monthly expected move. Pay close attention. S&P 500 is tagging it. It already tagged it, and now it's kind of floating right down, right there. We still have plenty of time left in the trading week, but we are at the upper weekly expected move. As far as the quarterly expected move, that can take us up to 4,200. That is one of those levels that I said pay close attention to, because if the S&P 500 decides to rip, Guess what? 4,200 would be a strong area of prior volume where we acted as support, we acted as resistance. And to note, it's based off of implied volatility, where that means it could take us up to the upper quarterly expected move. And we have 2 months still to reach that area. IWM is trading outside of its monthly expected move. See this red shaded area behind the screen? That actually represents a bear market territory, right? If you measure, and this is just basing it off from this high right up here, 20% down would take us there. So we're still in bear market territory in the IWM. As far as the Qs go, we're well into bear market territory, as you can see there. We're well outside of the monthly expected move with plenty of time left, and we are still below that quarterly expected move there too. Now I want to look at some BP charts. If you take a look here, this is the NASDAQ composite. Remember, a lot of FOMO happens when we get into these areas, and then people start to think that they don't matter. But as you can see through history, it goes from the top, it goes in the bottom, it goes in the bottom, it goes to the top. It's from the top and it's coming from the bottom. It will reach a time where it comes back down to the lower end. Now, I don't know what that looks like as far as price action, but at least you can know that we have a subtle negative divergence here. So it could resolve itself to the downside through consolidation, through a pullback. You know, it's tough to say, but it just lets you know, hey, you might want to tighten up your risk parameters, you know, be aware of it and move forward, right? If we take a look at the NASDAQ advanced decline line, which is hidden, and I applied two EMAs to it, it's a 21 and 50. You can see here we have a lower high on the 21 EMA and the 50 EMA on the advanced decline line. And you can see here, price action is actually heading higher. So we have a subtle divergence there in that breadth. And you can see the same thing here, played up, right? Up to the downside. It was a bullish one here, played up to the upside, bullish one here, played up to the upside, bullish one here, played up to the upside. Okay, so these do help for identifying and spotting potential topping, turning points, or periods of consolidation. BP INFO, this is the bullish percent index for technology. Now, if you don't know the bullish percent index, that's okay. You can always Google it. Don't get too involved in like the mathematics of it, but understand how it can potentially help you find turning points. You can look into mathematics. These basically this number here, 73.68, represents a percentage of stocks that are on buy signals based off of tic-tac-toe charts. I like to call them, right? It's just point and figure charts. And you can see here we are in the technology sector, one of the big sectors in that overbought condition, right around 71.63. If you look at the NYSE, New York Stock Exchange bullish percent index, okay, negative divergence forming there. It's very clear now that we are seeing, so it could potentially resemble that we might be topping off potentially. Remember, it can last a long time. This one right here lasted from mid-October to early December, all right? And then it resolved to the downside, came down to oversold condition with a positive divergence, which we called out, and it resolved back up to the upside. It didn't crash down through the floor. It pulled back. All right. Another thing to look at is growth to value, right? We talked about this on the last video. It was getting a little extended. We said, hey, careful here. Market pulled back. Market also showed positive move today, right? So it pulled back and then moved forward. So it was the tape telling us one story. The opening told us another. Now, if this crosses down through zero, that's typically negative. I've highlighted it on the screen many times. The red lines going across the screen represent when the line crosses down, and it's represented sometimes some good sell-off activity, okay? So be aware of that rate of change. Now, if you're wondering what rate of change am I using on this specific RS line that is currently hidden, it is the 10-period weekly, 10-period rate of change on the daily. Now, if we continue on, the last divergence I want to really call out here is copper. You can see copper is still consolidating in bullish context, so it could very well break this negative divergence that is currently forming, right? The higher high in the SPY, getting lower in copper. But if copper does start breaking, that could be the early indication that S&P 500 might need more time to breathe. That's all I got for you, everybody, on today's stock market brief. Hope it gave you some insight into the short term and in the more macro view as well as far as the bigger picture. See you later.